Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 2 question number 4. This is Paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 4 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve it under 35 minutes. So without any further delay, let's get started. Martina produces and sells a single type of product. The following budgeted information is available for the year ending 30 November 2025. Okay, we have the sales revenue, direct materials, direct labor, production overheads, and selling overheads, as well as profit for the year. Variable production overheads are budgeted to be 4 per unit. Selling overheads include 5% sales commission. All remaining selling expenses are fixed. We need to calculate the budgeted contribution per unit. Remember that contribution per unit is just our selling price minus the variable cost. So the first thing we can do is calculate the selling price per unit by dividing the total revenue by our number of units. So that's 542,500 divided by 3,500. This results in the value of 155. So that is our selling price. Now for the variable cost, we have direct materials. Again, we can figure out the direct materials per unit in a similar manner. We can just divide this 87,500 by 3,500. That will give the direct material per unit to be 25. So we can just write down here as well. Then the direct labor per unit can be found in a similar manner. We just need to divide 105,000 by 3,500, which results in 30. Then for production overheads, we have been told that the variable production overheads is 4 per unit. So we need to subtract this 4 as well. Then we have selling overheads, which includes 5% sales commission. Sales commission will always be a part of the variable cost because it depends on the number of units that is being sold. And it's 5% of the selling price, not 5% of the selling overheads. That's a major mistake a lot of the students make. But remember that whenever you have the percentage for sales commission, that is the percentage of the selling price. And we know that the selling price is 155. So the sales commission per unit will be 155 times 5%. Which is 7.75. Alright, this includes all of our variable costs. Now the budgeted contribution per unit is just 155 minus 25 minus 30 minus 4 minus 7.75, which is 88.25. Okay, now we need to calculate the budgeted fixed overheads for the year. Okay, we have 2 different types of fixed overheads. The first one is production overhead and selling overheads. But both of these include an aspect of the variable cost as well. So in order to calculate the fixed cost, what we need to do is just subtract the variable cost from these total amounts. So let's work with the production overheads first. The total is 126,000. Out of which we know that 4 per unit is the variable cost. So in order to calculate the total variable cost, we can just multiply 4 by the total number of units, which is 3,500, and subtract that. So 4 times 3,500. This will give us the variable cost from the production overheads. Then we repeat the same process for our selling overheads as well. We have a total of 157,500. And in this case, the per unit variable cost is 7.75. We have a total number of units of 3,500. So multiply these two together and subtract it. 7.75 times 3,500. So the fixed cost from our production overhead, which is this part, will be equal to 112,000. And the fixed cost for the selling overheads, which is this part, will be equal to 130,375. Now the total budgeted fixed overheads will be 112,000 plus 130,375, which results in the value of 242,375. That's all for the first part. Now we need to calculate the budgeted margin of safety in units as well. Remember, the margin of safety in units is just the total units minus break-even point in units. So we first need to calculate the break-even point, which is just the total fixed cost divided by the contribution per unit. And we've already calculated both of these values. So the fixed cost is 242,375 and the contribution per unit is 88.25. which results in 2746.46. Again, since we're talking about the number of units, we cannot have it in a decimal value. We need a rounded figure. So we just need to round it up. That will be 2747 units. Now the total units given in the question was 3500. We just subtract 2747 from it in order to calculate the budgeted margin of safety. So that will be 3500 minus 2747, which results in 753 units. Now we have been given the additional information. Okay. We need to prepare a marginal cost statement for the year ending 30 November 2025 to show the revised contribution and the revised profit for the year if Martina decides to go ahead with the plan. And we have the working section as well. Okay, let us show all of the workings related to these information within the particular box. Martina feels that production and sales could be increased by 20% by improving the quality of the product. Previously, the number of units were 3500. Now, the new number of units will be 3500. We need to increase it by 20%. So, 1 plus 20%. This results in the total of 4200 units. Okay, first information is done. She plans to make the following changes. Purchase new machinery at a cost of 60,000. The machinery will have an estimated useful life of 5 years and a residual value of 10,000 at the end of its lifetime. In this case, we are to prepare the marginal cost statement for the year, which means that we need to calculate the depreciation charge for the year. And that depreciation should be included within the new fixed cost. Let's do that. So for information 1, we're calculating depreciation, and the formula for depreciation using straight line method is cost minus residual value divided by the useful life. The cost is 60,000, the residual value is 10,000, and the useful life is 5 years. So the depreciation charge for the year will be 10,000. Okay. Then undertake an advertising campaign at a cost of 1,250 per month. But we need the total advertising for the year. So we just need to multiply 1,250 by 12. So second is advertising. 1,250 times 12, which results in 15,000. Then we need to reduce the selling price by 6 per unit. Okay, previously the selling price per unit was 155. Now we need to reduce it by 6. So the new selling price is just the previous price minus 6, which is 149. Then we need to purchase higher quality materials that will increase the direct material cost by 3 per unit. Okay, previously the direct material cost is 25. Now we need to increase it by 3. So the new direct material is 25 plus 3, which is 28. Then direct labor hours per unit will reduce by 5%. So if we are reducing the direct labor hours, it means that the total direct labor cost per unit will also be reduced by 5%. Previously, the direct labor cost per unit was 30. Now we just need to reduce it by 5%. So new direct labor is 30 times 1, since we are reducing, minus 5%. So that will be 28.5. Then use of the new machinery will reduce the unit variable production overhead by 20%. Okay, previously the unit variable production overhead was 4. Now we need to reduce it by 20%. So variable production overhead, previously it was 4, we now reduce it by 20%. So that will be 3.2. Then sales commission will remain at 5%, but commission on all units sold in excess of 3,500 will be paid at 10%. Okay, this is a bit tricky. So for sales commission, for 3,500 units, it will be at the rate of 5%. 5% of the selling price, which is 149. So 5% times 149 is 7.45. This is the rate for the 3500 units, and in excess of the 3500 units we need to pay the sales commission at the rate of 10%. So in excess, that's 4200 minus 3500 units, which is 700 units. So for these 700 units we need to pay the sales commission at the rate of 10% of our selling price. So the commission is of 14.9. Now the last thing we need to calculate is the new fixed cost. Previously the fixed cost was 242,375. Now within this fixed cost we also need to include the depreciation charge and the advertising cost. So plus 10,000 plus 15,000. This results in the amount of 267,375. Alright, we have all the information that we require in order to prepare the budgeted marginal cost statement. So let us start with our revenue. So for the total revenue, we just need to multiply the number of units to the selling price per unit. In this case, the new number of units is 4200 and the selling price per unit is 149. So 4200 times 149. This results in the revenue to have the value of 625,800. Then we subtract all of our variable cost. The very first variable cost is our direct material. We have the new price for the direct material per unit, which is 28. We just need to multiply it to the number of units. So 4200 times 28. This results in the value of 117,600. We need to subtract it. Then we have the direct labor. Again, number of units multiplied by the rate per unit. The new rate for the direct labor is 28.5. This results in the value of 119,700. Then our next variable cost is the variable production overhead. So variable production overhead, and this was given per unit. So again, we multiply it by the number of units. New rate for the variable production overhead is 3.2 per unit. So the total variable production overhead will be 13,440. Then we have our sales commission. So for sales commission, we have two different levels of the units. For the 3500 units, we need to multiply it by the rate of 7.45, and for the 700 units, we need to multiply it by the rate of 14.9. So for 3500 units, we have the rate of 7.45, and for the 700 units, we have the rate of 14.9. So this gives us the total sales commission to have the value of 36,505. Now we have included all of the variable costs, after which we need to calculate our contribution. So the contribution is 625,800 minus 117,600 minus 119,700 minus 13,440 minus 36,505, which results in the value of 338,555. Now from the contribution, we just need to subtract our fixed costs. Again, we've already calculated the new fixed cost, which is 267,375. And this will give us our profit. So that's 338,555 minus 267,375, which results in 71,180. That is all for the required statement. Let's move towards the next part. We need to advise Martina whether or not she should go ahead with the plan. We need to justify our answer by considering both the financial as well as the non-financial factors. Okay, this is of 7 marks. So whenever we are doing advice questions, we need to reserve 1 mark for our final decision and divide the remaining marks among the factors or the options. In this case, we do not have 2 different options. We only need to talk about the one offer that she has. So we will just divide the 3 marks into financial factors and 3 marks into non-financial factors. Let us start with the financial factors. The very first financial factor we can consider is our profit. So we have the previous profit, which was 66,500, and the new profit, which is of 71,180. We can calculate the increment in profit. Let's do that. So increase in profit will be the new profit, which is 71,180, minus the previous profit of 66,500, divided by the old profit, 66,500 times 100. So that is 7.04%. So that is the increase in profit we have. Then the next item to be included within our financial factor is the increment in the fixed cost due to the depreciation and advertising. Let's write it down. Depreciation and advertising will increase fixed costs, which will in turn reduce profits. Then the third financial factor we can talk about is the finance plan for the new machinery, because the new machinery requires 60,000 and there is no mention of the finance cost that will have to be factored in order to purchase this new machinery. Let's write it down. The finance cost required to purchase the new machinery has not been factored into the plan. That is all for our financial factors. Now let's move towards the non-financial factors. Okay, in this case, I guess we are improving the product as well. We are improving the quality of the product. So the very first non-financial factor is that whether or not the customer will remain loyal to the new product change. We can question it. So will the customers remain loyal to the new product design? Okay, then we are also cutting down on our labor hours by 5%. But this is just an estimation. We do not know for sure whether or not the new machinery will actually save the 5% labor hours. So we can question that as well. Will the new machinery actually save 5% labor hours? Then the third non-financial factor is whether or not the advertising campaign will result in the expected increased sales. So will the advertising campaign result in the expected increase in sales? Okay, so we have 6 different points. Now based on these factors, we need to make a final decision. Okay, in this case, I would suggest Martina to go ahead with the plan, because I think she will be able to increase the sales by additional 700 units, because now she is providing additional incentive to the sales workers, because she is providing 10% sales commission on the sales happening above 3,500 units. So that could act as a major incentive. Martina should go ahead with the plan as she could achieve the intended increase in sales by 700 units due to the additional sales commission of 10% above 3,500 units. That is all for this part. Let's move towards the next one. We now need to explain one advantage of cost volume profit analysis. So cost volume profit analysis is very simple. We just change one of these three factors and figure out its impact on the remaining two factors. That is what cost volume profit analysis is. So the very first advantage would be that it will enable a business to know the amount of profit generated at different levels of outputs if we change the volume, and therefore how much to produce and sell in order to prevent a loss. Let's write it down. It enables a business to know the amount of profit generated at different levels of output and therefore how much to produce and sell in order to prevent a loss. That is all for the fourth part. Let's move towards the next one. We need to explain one reason why marginal costing is considered to be more useful for short-term decision making than absorption costing. This is because marginal costing will allow a business to calculate contribution, which only accounts for the variable cost. This will help the managers decide whether the special orders should be accepted, whereas absorption costing will treat fixed cost as part of the product cost because it accounts for both the variable cost as well as the fixed cost, which makes the decisions impractical. Let's write it down. Marginal costing enables a business to calculate contribution, which helps decide whether special orders should be accepted, whereas absorption costing treats fixed cost as part of the product cost, which makes such decisions impractical. That is all for the fifth part. Let's move towards the next one. We now need to explain the effect on profit of using marginal costing rather than using absorption costing. Okay, it's very clear that if we use marginal costing, then we will have a higher profit if the inventory levels decrease, and we will have a lower profit if the inventory levels increase, because inventory valuation in marginal costing will only include the variable cost and not the fixed cost as part of the product cost, whereas within absorption costing we include the total cost while valuing the inventory. Okay, so using marginal costing will result in higher profits if inventory levels decrease and vice versa, as inventory valuation in marginal costing only includes the variable costs, unlike absorption costing, which includes both the variable costs and the fixed costs. Alright, that is all for this entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you are subscribed to this channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.